2021, I'm going to give you some stats. We now have 42 properties. So we acquired 32. We now have over 1 million square feet, 1,086,000 square feet of storage. We have acquired all of our storage facilities for $59 million. We acquired just over $50 million. We acquired $50 million, $11,000 worth of storage this year. We have 34 employees now. So we hired 30 people. We're in 8 states now. This is mind-blowing stuff. 2021 annual update. I sent a very similar letter to what I'm about to say out to my newsletter. I sent out, I will send out a formalized version of this letter to my investors. There's over 200 active investors now in all of our deals. This is an update on 2021. Now, if you rewind to the end of 2020, hadn't started this podcast yet, but I was starting I was still recording the Sweaty Startup podcast. I was just about to close on selling our company, our service company. That was a 7-figure exit, very low 7 figures, not a life-changing amount of money. But if you look back on where we were from a portfolio perspective, let me pull up a document right here. At the end of 2020, and actually on the last day of 2020, we closed on a building. We had 10 properties. We had 223,000 square feet. We had 2,000 units. And we had acquired storage for a total of $9,220,000. I think we had 5 or 6 employees at that time. We were still running our service company. The closing hadn't happened yet. And I remember sitting back and talking about some of my goals for 2021. What did we want to accomplish? How much storage did we want to acquire? And so much of what we do in the real estate game is dependent on kind of what the market gives you. If you're me, you always kind of think that the next deal may never come. We may not find a good deal that we like, especially when you get shot down 3, 4, 5 times in a row on new acquisitions. You just can't find a good deal, and you get nervous that you're never going to be able to find something worth buying again. So it's really hard to set goals in our business. But I think we wanted to acquire, $10 or $20 million of storage. Lofty goal. What ended up happening this year is quite mind-blowing. Let's rewind 2 years and look at our portfolio on December 31st, 2019. We had 7 properties, just under 100,000 square feet. So 7 very small properties, average of 15,000 square feet each. We'd acquired them all for $4.5 million, and we had 1 employee, me. That was 2 years ago. I really didn't have access to capital. I had not gotten serious about Twitter yet. I can tell you a little bit about Twitter here in a second, but we were small time. And I remember at this time, I wanted to acquire $20 million worth of storage over the next 5 years. That was our goal. 2020 was a pretty big year. We only acquired 3 properties, but COVID hit. We sold our company, or we were about to sell our company. And we bought 3 big properties, 126,000 square feet for $4.7 million. And we hired 3 more people to make 4 total employees in that year. So on this day, 1 year ago, we had just acquired a property in rural Pennsylvania that ended up being a phenomenal deal. We had 10 properties, 223,000 square feet, and 4 employees. Now, 2021 has been a wild year. You've been following me. And frankly, if you have a crystal ball and you go back 2 years, to the end of 2019, and you say, hey, if you're asking any real estate investor, they say, what asset class would you get into right now? What should I get into right now? What would be the best asset class to get into right now? I think self-storage, looking back, hindsight is 2020. If you had a crystal ball, self-storage was the answer. We have been incredibly blessed in our business. Street rates across, all the REITs are up 25%. Revenue up 15% year over year. Again, that's the same as Google. Self-storage as an industry is growing at a similar pace as Google. And our storage facilities have been no different. Our 10 properties, our revenue growth is up 25%. Our NOI is exploding. And frankly, we are doing very, very well. The buildings that we bought are worth, even earlier this year, some of them are worth 50% more, 100% more. It's mind-blowing stuff. Now, 2021, I'm going to give you some stats. We now have 42 properties. So we acquired 32. We now have over 1 million square feet, 1,086,000 square feet of storage. We have acquired all of our storage facilities for 59 million. We acquired just over 50 million. We acquired 50 million, $11,000 worth of storage this year. We have 34 employees now. So we hired 30 people. We're in 8 states now. This is mind-blowing stuff. I cannot believe how fast we've grown. And I'm the one speaking to you right now. And I want to start with talking about some of the struggles because I make it all sound easy on Twitter. And it is easy to type on Twitter. But what we do is quite tough. And finding deals is the hardest part. This year, we've made significant investments. That was about 6 months ago, actually. In July, we made significant investments on the acquisition side, hiring competent people to cold call self-storage owners. And when you have 3 full-time folks doing that, you have a lot of deals to underwrite. So we had to build a team to underwrite deals to figure out what they're worth. That was 3 more hires. So we've invested heavily, 6 people now in that division of our business that their job is to make it rain. Their job is to bring storage owners, get them on the hook that want to sell their buildings. That's been a big part of it. We acquired over half of our deals this year off market. It's also really hard to structure all these things from a financial standpoint. Because in every deal, 3 people need to make money. The LP, the investor, me, the GP, and the management company that actually manages the asset. So there's really 3 mouths to feed in every deal. How you structure it and how you one company charges the other company. That's been a real struggle of mine this year. We're still revamping, and we just made a change to how our management company bills our individual buildings. But structuring that has also been really tough. And having management in-house, anytime you hire 30 people and bring on 32 facilities, over 800,000 square feet of storage. By the way, 800,000 square feet, our average size per facility, not deal, per facility, is over 26,000 square feet this year. That's much higher than I thought. You talked to me 2 years ago, I'm thinking, we're going to buy a bunch of 10,000 to 15,000 square foot facilities because they're small. Nobody else is buying them. We've already outgrown those deals. If you're starting out in real estate right now, that's where I recommend you start because the money can be really, really good. But when you have 3 mouths to feed, a real estate private equity company and LPs and a management company, and you have all the overhead of 30 employees, you have to start doing bigger deals. Real estate is one of the few areas where scale, size, volume can be somewhat of a disadvantage because you have higher expenses. As you grow, you need to do bigger deals because a bigger deal is the same difficulty to pull together as a smaller deal. And when there's more money on the table, it's more worth it. Our time is more valuable. So we found worked our way up to doing bigger deals. So we have to do a hell of a lot of work with our employees to keep our buildings clean, rented, and all these vendors in place. And it's been tough to build those systems, but we've done it. And I'm really proud of that. So in the last quarter 4, we did over half of our volume for the year. $30 million worth of storage in the last quarter of 50 million total. And our team is finally taking a break. It's December 31st. It's New Year's Eve as I'm recording this. Our team finally had the day off. We closed our last deal in Northwest Georgia yesterday morning. So, man, it has been stressful. And another thing to note is while we're building this company and while we have all these employees, I cannot physically have a job. Nick can't be responsible to do anything. So I'm not taking LP meetings. I'm not doing investor relations. I'm not underwriting deals. I'm getting the final look at deals. I'm very involved with the underwriter. But I can't have a job in the company or that becomes a bottleneck when you're growing this fast. Things fall through the crack. My job is one thing only, and that is go out, sell, hire, attract talent, and bring them in and set them up for success. So I'm training people, I'm giving them the tools to succeed, I'm checking their work, I'm holding them accountable. And that's my job at this company as CEO, as leader. What keeps me up at night? I'll talk about that next. I think it's debt. We have a lot of term debt right now. We have a lot of 3-year terms, 2 years IO. We're buying assets and we need to turn them around in 3 years. And I'm not afraid of rate risk because we have in place cash flow right off the bat. Our debt yield is almost 10 right off the bat. But we really need to secure longer term debt to reduce some risk when terms expire. When the great financial crisis happened, and again, I was not doing real estate at this time. All I've done is read and study real estate and talk to as many people who went through it as possible. When the great financial crisis happened in 2009, the people who were on terms, their loans were expiring, meaning like, hey, I got a 3-year term with KeyBank right now. On the 3rd year, they want it off their balance sheet. I need to place that debt somewhere else. If your loans were expiring during the great financial crisis, the banks basically called your loans because you couldn't find new financing. They didn't want it on their balance sheet anymore. Commercial real estate was crashing and you were screwed. And that's how a lot of people went belly up. So I'm not afraid of rates. We know that rates can go up to 6 or 7%. We're not going to lose any buildings, 8%, 9%. We're going to be just fine. But if our terms are expiring and we can't get new loans and they call our debt, we're going to be in some big, big, big trouble. So a Q1 problem that I'm solving right now is securing longer term debt. I'm working on going out and selling bankers right now on all of that. And there's so many moving pieces with debt and how to secure it and what types of debt and swaps and CMBS debt and balance sheet debt and life co debt and agency debt and defeasance and all these different things where there's trade-offs, right? Every product has trade-offs. CMBS is long-term interest-only loans, but there's humongous defeasance. You basically have to pay all the remaining interest or the remainder of the loan if you get agency or CMBS debt. So it can be tough. It can be really tough. But I think I'm going to find a good product. Our buildings are performing really, really well. We're in a good spot. Let me talk a little bit about the fun stuff now. Our last business, the student storage business, where we were driving around box trucks, picking up student stuff in 12 cities in 8 states with 150 part-time employees who didn't really care. That was a really, really hard business. It took a lot of energy. It took a lot of capital. It took a lot of logistics and management to oversee that business. A lot of stress. You're talking about an Uber model where you need to have a truck that's fully outfitted with competent employees at a specific location, in a specific city, at a specific time, in a labor crunch, in a real estate crunch. The 2 big inputs is labor and real estate and what we do because we had to rent commercial real estate to store stuff. Tremendous shortage. So we've worked our way from that hard business to self-storage facilities. And self-storage facilities are still tough. I'm not saying it's easy. I'm not saying we're not super focused on putting out fires and solving the problems, but there are way less emergencies when you're renting somebody a steel box. And everybody who calls in needs the same thing. Hey, I need to pay my storage bill or I need to rent a unit. We are having a lot of fun in the real estate business. Our goal, one of my life goals, one of my things I believe wholeheartedly in is that everybody should make their way from a really tough business and keep, as their career goes on, getting down to easier and easier and easier businesses. We found an easier business. This is a good business. We have capital. We have money that we're making quickly so that we can hire and attract top talent. Their jobs aren't that complicated, so they can come in and start kicking some ass. And we're having a lot of fun in this business compared to our old business. Another thing that's really fun about what I'm doing right now is that our buildings are performing like crazy. We're buying the buildings that we bought in April and the building that we bought a year ago. The buildings that we bought in July and August are already at their 24-month pro forma. The revenue is blowing us away. These deals are very good. The buildings are worth a lot more than they were when we bought them already. That makes my job easy. It makes me look like a genius, but it's mostly self-storage tailwinds. It's easy for me to get a big head and get cocky and forget about all the things I should be worried about when the whole business is just going really, really well. An example of that is we bought a 30,000 square foot property in a rural town on New Year's Eve last year, December 31st, this day 1 year ago. We bought it for $1.3 million. It sat on the market for 4 months. This is just an example of the market now. It sat on the market for 4 months before anybody bought it. A lot of people were afraid of it. We came in and said, okay, we think we can find top market rent. We think it's a lot higher than what they're charging. We're going to buy it. 10 by 10 units at that facility were rented for $48 when we bought it. $48 for a 10 by 10 unit. We didn't know where the rent was going to go. We knew that everybody in town was full. So we decided to raise rent to $70 when we closed. So $70 when we closed, nobody moved out. A couple people moved out. We replaced them right away. So business is booming. We went from $13,000 a month in revenue to $20,000 a month in revenue, $21,000, and the facility's a lot more valuable. Great, right? Well, we're still full. We don't know where the top is, so we set the street rate. Everybody's still paying $70 for that 10 by 10. We set the street rate at $120, meaning new tenants off the street get to choose whether or not they rent from us. $120 for a 10 by 10. We've rented 6 of them in the last 2 weeks at $119. 6 units at $119 over the last 2 weeks. That is mind-blowing. So, naturally, makes us look really easy. What is next for us? Now, that's a really tough question. My job is to worry. My job is to think about what could go wrong and mitigate that risk. My job is to protect the downside. I have a lot of people investing money with me. I have a lot of my own money. I'm personally guaranteeing a lot of loans. My job is not to be a bull. People don't pay me. LPs don't pay me good fees to be bullish and confident and think, oh my God, all we got to do is buy. The market is amazing. We're going to take over. We're not going to worry about the details. We're just going to buy. So that is not exactly what I spend my time doing. I spend my time worrying about what could go wrong, what levers are outside of my control that could go wrong. So I spend a lot of my time thinking about how I can manage the risk. And if those things do go wrong, how we can make sure that we are well positioned. I don't get paid the big bucks to be a bull. I get paid the big bucks to protect the downside. On the other hand, we're confident. I mean, how could we not be confident when things are going so well? We are investing heavily in our team so that we can grow. We're going to continue to invest in acquisitions. We're going to continue to invest in operations. I have 2 to 3 people right now that I'm working on hiring and recruiting away from their jobs. I'm going out and I'm hunting them to try to get them. I'm selling them on our vision, on what we want to do. They're going to be expensive, but we're ready to pay up for good talent. So we have a couple deals closing in Q1. Let me see here. We have 6 properties under contract. As far as square feet goes, another 200,000 square feet of storage that's under contract right now. And as far as purchase price goes, $10 million. So shoot, we have $10 million in the pipeline right now. That's good. I was just feeling down about how much we have going on right now because we lost a couple big deals this week. But we're going to keep going. I mean, we are making sure that we're not overpaying. We're losing a lot of deals. Other people are definitely paying more for us, more for storage than we are. And to put it in perspective, we kind of think about the general main assumptions that we're making when we're underwriting deals. What could go wrong? Of the deals that we've acquired in the past year, by month 6 months in, on average, we've increased revenue at that facility by 40%. 40% revenue growth over the previous owner. How are we underwriting deals now? We're generally underwriting a 15% revenue increase year 1. So significantly less. And then you think about operating expenses, the operating expense ratio, what ratio of expenses to revenue. Across our portfolio, we're operating under 35%, but we know that at any given building, we could get screwed on property taxes. Insurance is going up a lot. So we're actually underwriting north of 40% expense ratio. So we are staying very disciplined with our underwriting. Our goal is to underpromise and overdeliver. We're not sure what deals will outperform. I don't even know what deals will do the best. A lot of our LPs ask us, hey, Nick, can you make sure you put me in the good deals? And my dad, for example, only had so much capital, wanted to get in one good deal last year. I picked the wrong deal because I never know which deals are really going to do well. Our one in Connecticut is doing phenomenal. I put my dad in one in New York that's also doing fine, but it's not even close to how well the one in Connecticut's doing. So I just don't know. We don't know what's going to happen when we come in, when we raise rents. We don't know. which ones will do well and which ones won't. But the deals that we have right now, I analyze them every night. The amount of information that I have at my disposal from sitting right here in my office in Athens, Georgia is incredible. I can look at, how many move-ins and move-outs are at every single location. I log in every night and I look at how many customers moved in, how many customers moved out. And I can see, and I can get a really good idea. I'm all over our Google AdWords, our Spare Foot leads, our call volume, how many calls are missed, what time of day people are calling, how many units are made available as far as the maintenance staff to get in, to clean up. I can see everything. So I'm constantly in there fiddling and thinking about those things. So another thing is just this economic environment that we're in right now is insane. And it's really, really tough for me, an inexperienced capital allocator, to navigate. We've seen 100 basis points of cap rate compression in the past year, meaning all the facilities out there are getting more valuable for the same amount of revenue, same amount of profit. We're seeing inflation take off at 15, 20%, depending on who you ask. And I believe a good real estate private equity shop, like what I'm trying to build, finds a way to do business responsibly in every environment. Of course, the deals we're buying right now are not as sexy as the deals we were buying 6 months ago, but they're still damn good. They're still downside protected, and we're finding a way to do business in any environment. Right now, that means less debt, because debt is the risk factor. A year ago, we were doing 70% LTV, 75%, 80% LTV on some good deals that we were buying. Today, we're doing 52% loan to cost on most of our properties, meaning 48% of its equity cash that comes in. That sucks from an IRR perspective. It hurts your cash on cash return, but it protects the downside. So we feel really good about the risk adjusted return there. So, how do I think about inflation? How do I think about what's next? If inflation keeps rocking north of 10%, it's going to be good for me. Well, not always, right? There are some downside scenarios there. Interest rates are going to go up. Debt's going to get more expensive. We could enter a debt crunch. That's a significant risk of inflation. On the other hand, I have month-to-month leases. We have pricing power. We can raise rents with inflation. Are the people in these small towns going to be able to pay the rents? A lot of questions around that. The assumptions that we're making have to be bomb-proof. And frankly, I'm buying a lot of Class C assets, rural properties. We're snagging a lot of nice ones too. I undersell my portfolio when I talk about it online. We got a lot of nice big facilities with paved lots and good, good looking buildings with gates and security cameras. But when you think about the levers that are outside of my control, what will somebody else pay for our portfolio? How much is it worth if we had to sell it? Right now, the big players are not buying what I have. There's a lot of companies just like mine that are going out and paying good money for them. But the big players, the REITs, the Public Storages, the Extra Space Storage, the CubeSmart, they are not acquiring assets like mine. I don't know what will happen over the next 10 years. I don't know if they'll get interested. I have no idea what to expect. So I have to assume that I'm not going to be able to sell. Anything that we buy, we're assuming we are not going to be able to sell it for 10 years. I would like to structure it so that I don't have to sell it in 10 years, because passive long-term cash flow is one of my goals, and tax-efficient cash flow over the long term is the goal of a lot of our LPs. It's tough. This is really tough. I'm making a lot of decisions every single day that have a big impact on the future. It's nerve-wracking. I'm trying to get all the information that I can. I'm trying to have an open mind. I'm getting advice from a lot of people. I'm getting a lot of advice of people who are very bullish and think the world is just going to rip and the economy is going to go, go, go. And I'm getting advice from people who think that doomsday is coming and we're going to enter a massive recession. And I'm taking those two pieces of advice with equal weight, right? I'm trying to have a very open mind. I'm not getting too cocky. We're staying disciplined with our underwriting. We're managing our risk with lower debt. And in my opinion, we're doing a good job of finding a way to responsibly acquire assets in any economic environment, because this is crazy. But I'm excited. I'm excited about 2022. And when it comes to setting goals, a lot of people are asking me what our 2022 goals are. I don't know. I think we've got the machine built to buy $100 million worth of storage. Will we find that many deals? I don't know. I think we're going to stumble upon a massive deal this year. I think we're going to take out a $25 or $50 million portfolio. We're finally ready to confidently bid on those. I lost 2 of those this year. Just wasn't ready. It would have been a big stretch financially. It would have been a big stretch for our money raising machine. It would have been a big stretch for our operations. So we missed those. But when you think about how we are primed now and how confident we are now, we may stumble across a couple big deals. I also know that we're going to buy a lot of $1 to $3 to $5 million facilities. How many? I don't know. It's really hard to guess. We are going to take what the market gives us. We're not going to push it. We have a good, healthy company set up so that we don't have to do deals to make money. It's another huge part that I'm so proud of what we're building. Some LPs, they don't like our fees. They think, oh, your management fees are too high. Oh, your pref and promote are too high. Your AUM fee of 1% is too high. And it's my job to build a business that I can attract and hire and pay top talent, even if we're not doing deals. So I'm going to have this 1.5 million of payroll on the books. I have to find a way so that if we stop doing deals, there's no more acquisition fees. There's no more new deal fees. I can pay all of my people, and they're all going to stay happy, and they're all going to ride through the storm with us, and we can manage the properties really well. We can continue to hire if we need to. We are doing that right now. We're not wildly profitable in our management company. We operate at about a 20% margin, but the management company is profitable in its own right. The real estate private equities company is profitable in its own right. I'm not sending my kids to private school on the fees, but it's a healthy company. And that's very, very important in case things change. So thanks for listening. A lot of rambling, a lot of thinking, a lot of decisions that are going to be made. I'm going to spend a lot of my time in 2022 hiring top talent, attracting, trying to train, or trying to sell top talent on our vision, because we need more talented people. I know who they are. I'm going out and chasing them right now. We're going to continue to deploy capital in a responsible way, and we're going to take what the market gives us. So as far as goals, we don't have any goals. I'm going to put one foot in front of the other. I'm going to stay disciplined, stay focused, and take care of business. Juniper Square, the sponsor of our show, recently did a capital raising survey. And in this survey, they asked 142 senior executives at US-based commercial real estate firms a series of questions to understand the state of commercial real estate fundraising. It's an insanely valuable report with data on questions like, how much capital did you raise last year? How long did your last raise take? What type of investors are you raising the most from? And what strategies are working the best for you to find new investors? Download this report for free at junipersquareresearch.com. That's junipersquareresearch.com. Big thank you to Juniper Square for sponsoring the show. Thank you for listening to The Nick Huber Show. Just wanted to remind you that we have a paid real estate community where some really special stuff is happening. People are breaking down deals. People are networking. People are, I think, even formulating partnerships inside this group. We have over 100 members now. For more information, you can visit sweatystartup.com/REC. And the first 299 members of the group, to get some momentum, get $200 off the annual membership using the code FIRST299, FIRST 299. And also, you can check it out for 5 days for $1. You make a $1 payment, you can check out the community for 5 days. Highly recommend it if you're serious about bringing in some other people into your network, into your life, to help you become a better real estate investor.